So on April 26th, we're going to be doing a webinar with Liberty Home Equity Solutions, and they're going to teach you how easy it is to do a reverse mortgage and just how much cash there is on these things. And I'll tell you this. People run away from reverse mortgages because there's more money on the table. There's nothing wrong with that. Right. It's a great loan that helps seniors.
Oh, big time.
So, I said I went through this. Frank is preparing to go through this, and we said this time and time again. Learn this stuff forwards and backwards because you have aging people in your family too that you can help out with reverse mortgages. Right. Click this banner right over there. So check this out, Frank. In the country right now, there is a total of $5.4 trillion in untapped home equity.
Okay.
$5.4 trillion.
That's a lot of trillion.
That's a lot of trillion. Think how big that number is.
Right.
Which, by the way, is 10% more than the pre-recession peak in 2005.
Wow.
Now, let that sink in for a couple of seconds, guys. It's 10% higher than before the meltdown.
Gotcha.
Homeowners' equity that is tappable from a study that was conducted by Black Knight Financial. And consider this, guys. They're looking at tappable equity at 80% loan to value, meaning the real number is even higher. This is totally nuts. We are a culture that values stuff.
Yes.
The more stuff I get, the better.
Yes.
Yet we're not tapping into our equity and getting more stuff.
True.
Are we growing up?
I think we are. Anyway, right now, mortgage refinances only represent 32% of all loans being done.
Right.
And that's a remarkably low number. Well, higher rates mean fewer refinances, right? So here's a map of the country and the regions that have the most tappable equity. Of course, Los Angeles, San Francisco, and New York are well represented. But even look at all of the Texas, Boston, Miami, Chicago, Milwaukee type states here, man. Massive amounts of tappable equity. Now, and I'm not joking, but you should contact your database and let them know if they're thinking about doing a debt consolidation refinance. They better do it today rather than tomorrow.
You're totally right on this, Frank, because here's what's going to happen. You've got a bunch of people right now who you've done loans for who bought a bunch of stuff.
Yes.
Now they have high rate revolving debt and high payment closed in debt from CDs and stuff like that. Now, they're saying to themselves right now, I don't want to do a cash out refi because I like my 3 7/8 fixed rate mortgage. It's really good. Right. Now, what's going to happen is the burden of those payments are going to weigh on them. Then, in about a year from now, they're going to say, you know what, man? I got to pull the trigger on this thing. Then at that point, they'll be looking at a rate that's even higher than the one they're going to get today. So, though a debt consolidation refinance may hurt today, it's going to hurt a hell of a lot more tomorrow. So, what I'd do if I were you is I would outline this very scenario and send it to your past clients. Now, the best way to do this, of course, is in video, saying, hey, this is Brian over here at ABC Mortgage. I did a loan for you before. Well, you've got a really great rate that you don't want to touch on this thing, but understand that rates are going up, and there's a good chance that you might have debt from things that you purchased since you bought the house. And if you're going to do some type of consolidation debt, it's better to do it today because everybody knows rates are going to go up. If you want to see how this works, make sure you give me a buzz and send that type of message out because they're out there right now.
See, because 75% of those with this tappable equity have rates below current rates, which means most will want to go with a HELOC, right? Because that's the natural move, and it's one that we would get behind in previous years.
Right.
However, depending on their amount of debt, consider 2 points.
Right.
Okay.
2 points. One.
Most of the HELOCs are no longer tax deductible.
Right.
Okay. And two, that HELOC payment is probably going to go up.
It is.
Typically adjustables, right? Seriously. There's a debt consolidation market out there to be tapped right now, and all it needs is the right messaging from you. So do it before your competition does. And trust me, they're gonna.
All right, here's one that's not terribly surprising.
Okay.
Did you know in 2016, FHA insured nearly 10,000 loans worth about $1.9 billion for borrowers that are not eligible for financing? Oops, for FHA financing. Oops, not a good thing to do. Do you smell some buybacks coming here, Frank?
Probably.
So what happened?
Well, these loans were made to people who were not eligible for insurance because they were made to borrowers with delinquent federal debt or who were subject to federal administrative offset for delinquent child support.
So if you're delinquent to a government agency, you can't get a government loan.
Got it.
Agencies like the Department of Education, the DOJ, and the Small Business Administration. Yet, here we are with nearly 10,000 of these deals, Frank.
Okay, well, the OIG says FHA's mortgage insurance risk is now more at risk.
Bah humbug.
Well, let's not get carried away.
Right.
It's not like they're just crap loans at this point. However, the OIG recommends that HUD spruce up its do not pay portal to better catch deadbeat dads who don't pay child support and those delinquent on federal debt.
They also recommend that FHA revise its single-family handbook to comply with a regulation that prevents loans to borrowers with delinquent child support subject to federal offsets and schedule the timely renewal of data sharing agreements to prevent data loss in the Credit Alert Interactive Voice Response System, or better known as CAVERS.
There you go.
If the information is duplicated, they want to get rid of CAVERS and really kind of push this do not pay portal.
Okay, so CAVERS going away.
Yeah.
Now there's a story for you.
Right.
The point is, it doesn't look like FHA's coming after lenders for defects as they seem to be suggesting that the problem is with, let's face it, a very, very small group of loans. And it is indeed the fault of the FHA at this point.
But this is really interesting, Frank, because we've discovered a problem and we've got HUD over there who is accepting responsibility, a government agency accepting responsibility for an F-up and not charging the lenders. Who's running these companies, Frank? I don't know who they are.
It's a brave new world out there, Brian, and that's what's going on. So
Maybe they're growing up too.
Maybe, just maybe. Well, there you go. You guys have a great day. Leave us your comments down below and have a fabulous weekend. We'll see you back here on Monday.
And I'm looking forward to seeing you guys at the Puget Sound Mortgage Group next week, south of Seattle and Fife. It's going to be a good time.
There you go. All right, you guys have a great one. We'll catch y'all later, and I'll be in Vegas. Jeez, man, we got all kinds of things going on. We're just a traveling Wilburys right now.
I know. Boston, here.
You guys have a great one, man. Forward, share, subscribe. We'll catch you later here at the National Real Estate Post.
I think it's Baston, not Boston.
Baston. That was really fun, by the way.
It was fun.